Dear viewers, the recent correction has wiped off trillions from the stock market. If you tune to financial channels, you will see experts listing out reasons. Iran-Israel conflict, China stimulus, regulatory changes, and so on. Well, that's mainstream media for you, good at coming up with a whole host of reasons for every fall or gain. Guessing the timing or factor for market correction does not exactly help and is a futile exercise. As I keep sharing, the list of unknown unknowns in the markets is always bigger than what I and experts can know and talk of. Bottom line, do not try to predict, but always be prepared. Indian stock markets have been overvalued for some time now, and despite recent correction, remains so. Market cap to GDP, price earnings to growth ratio, or small cap to Sensex ratio. Whichever metric you choose, the stats suggest a huge premium to the median valuations. But the most revealing sign of the froth in the market is insider selling. The insider sales are estimated at rupees 1 trillion this year. At this rate, it is almost 6 times of selling in 2018. When the owner of the business is ready to sell his stake in the open market, there is a very good chance that he is getting a very good deal. Unfortunately, at the other side of this deal are the retail and institutional investors. Don't be surprised if the correction goes deeper. In fact, in this scenario, look for some defensive themes in investing. Speaking of which, wedding is one theme that deserves attention. India is home to 1 crore weddings annually and is the fourth largest sector in India. Vanity, celebrations, aspirations, and once-in-a-lifetime event. The emotions behind this event are such that people don't mind splurging, thus making it a defensive theme. For most Indian families, it is the most expensive event they save for their entire lives and spend it with a sense of pride. Some may find this extravaganza unnecessary, but the truth is that it keeps the economy lubricated. In the prime season, the business generated through weddings is estimated at over rupees 4 trillion. The typical budget for a wedding doles out huge share for venue and catering, gifts, wedding, jewelry, garments, honeymoon, and event planning. Some of the obvious names riding these themes are jewelry companies: Titan, Kalyan, PC Jewelers, Senco Gold, Sky Gold, Thangamai, Ian Gadgil and Sons. Within wedding attire, the well-known listed players include Vedant Fashions, Raymond, Arvind Fashions, and so on. Within the gifting segments, companies like Ethos and Lau Pala tend to benefit. For honeymoon, it is companies like Thomas Cook that ride the trend. You could find a bigger list of wedding-related stocks in the link below the video. But there is one specific company that I want to talk about in detail today: Sai Silks Kalamandir Limited. Remember I mentioned heavy insider selling at the start of this overvalued market? Well, one of the reasons I am digging deeper into this company is contra trend. Insiders recently have bought this stock through an open market purchase. Sai Silk is one of the leading players in South India that offers ethnic apparel and value fashion products through its 4-store formats: Kalamandir, Vara Mahalakshmi Silks, Mandir, and KLM Fashion Mall. Kalamandir is directed at middle income segment. Vara Mahalakshmi focuses on premium segment. Mandir is for ultra premium, and KLM Fashion Mall is for the value segment. Its offerings are priced between rupees 200 to rupees 3.5 lakhs. Its ethnic brands have one of the industry's leading repeat purchase rate. Now do note that South India itself is the largest sari market in Indian wedding and festive wear, accounting for around 50% of the organized market. The company is present across 4 states: Telangana, Karnataka, Andhra Pradesh, and Tamil Nadu through online and offline channels. The company plans to enter Kerala and Maharashtra as well. From 6.5 lakh square feet of the total store area, the company plans to add 90,000 square feet and then grow this base at 10 to 15% every year in new stores. The stores are mostly under a lease model. The company has 61 stores. By the end of 2026, the target number of stores is 100. Most of this expansion will be on premium format and the management expects better margins. It posted 18% operating profit or EBITDA margin in FY24. The sari market is witnessing a shift from unorganized to organized sector. The share of organized sector was 14% in 2007 and it improved to 32% in FY20. This shift bodes well for players like Sai Silk. June quarter this year witnessed exceptionally small number of weddings in a decade, leading to a muted performance and probably leading to the stock price correction. The wedding dates in June quarter were down 70% year-on-year, but despite that, the company maintained 41.3% gross profit margin. The debt is within the comfort range. The return on capital and return on equity in FY24 stood at 19% and 14% respectively. The stock was listed a year ago. The price band for the offer was 210 to 222. The stock is currently trading at a discount from that price and is down 46% from its peak. At 167, the stock is trading at a PE ratio of 30 times. The recent insider buying was at a level of Rs 174. Now do note that this is not a stock recommendation. The business has some inherent risk related to competition, execution on the store expansion front, as well as shifting consumer preferences. As such, any investment decision should be backed by due diligence. But amid an uncertain geopolitical environment and froth in the market, this is a company that you can put on your watch list as a play on defensive wedding theme. Press the like button if you found the information useful. Let me know through your feedback in the comments section. For more such updates, subscribe to Equity Master YouTube channel. Thank you for watching. Goodbye.